Hello, everyone, and welcome again to Wealth Matters for Physicians by Altfest Personal Wealth Management. I'm Mike Prendergast, a director of Altfest's Healthcare Practice Group and the host of this channel, which provides key investing and financial planning insights to help physicians achieve their important life and financial goals. In this video, my colleague Ryan Graham and I will discuss some smart financial moves that physicians can make in a down market. As you know, due to the volatility of the financial markets this year, prices of most stocks and bonds are noticeably down. Today we'll discuss strategies like Roth Conversions, tax loss harvesting, and gifting assets and how they can be financially advantageous to execute in down markets to help you strengthen your finances regardless of market conditions. Ryan will also answer one or two questions from our physician audience. Before I introduce Ryan, a few words about Altfest. For nearly 40 years, Altfest Personal Wealth Management has been helping physicians holistically optimize all areas of their personal financial lives in a fully objective, fee-transparent manner, while as a fiduciary, always putting their best interests first. We are honored to be the preferred wealth manager for members of the Medical Society of the State of New York, the preferred wealth management education provider of both the New York chapter of American College of Surgeons and the New York State Society of Orthopedic Surgeons, and a corporate partner of the Medical Society of the State of New Jersey, amongst other associations. Our guest today is my colleague, Ryan Graham. Ryan is a senior financial advisor here at Altfest Personal Wealth Management, where he works with physicians and their families develop and implement financial plans designed to achieve their personal and financial goals. In addition, Ryan serves on Altfest's Financial Planning Committee and has expertise in long-term care insurance. This is the first of two videos with Ryan Graham on smart moves physicians can make in a down market. I think that you'll find the strategies that Ryan will explain very beneficial. Ryan, thank you very much for coming on today on Wealth Matters for Physicians.
It's a pleasure. Thanks for having me.
Excellent, excellent. Well, before we dive into today's financial strategies, Ryan, let me ask you a personal question. So what made you decide to become a comprehensive wealth management advisor in the first place?
You know, Mike, I was one of those pre-teenage nerdy kids that was more interested in buying and selling stocks than playing video games, first of all. So that gives you a little bit of a sense of where I was at even growing up. But after many years later, entering the corporate world, working and consulting with large multinational banks, I really realized I was looking for something more when it comes to crunching numbers. I wanted more of that personal aspect of helping more people and also satisfying my itch for being in the investment world. So I was pretty pleased to enter wealth management, and now working with, Altfest is a fantastic way we get to, help people accomplish all of their financial goals every day. That's all we do every single day. So it's a pretty great world to be in.
Exactly. I think that all of our colleagues also, one of the things that we really like is you can really make a positive impact on people's lives, not just their financial lives, but then that financial life can spill over into helping them achieve their key goals.
Exactly.
So let's get right down to it, because I know you've got a lot of great information and we want to try to make this video as meaningful as possible to our physician audience. So we talked about that the headline is financial strategies that one can implement that can be beneficial when the markets are down. So just taking a step back on like a 10,000-foot level, when a physician is looking to implement various strategies in down market periods, what's the first thing that they should really be considering?
The physicians we work with, are extremely busy. So it's important to start out with the end goal in mind, in my opinion. So it's not about just seeking out the latest and greatest strategy. It's trying to get at what are your goals? What are you solving for? So that might be planning for a very great retirement, or making sure you're maximizing the amount of money you're leaving to your children, as another example. Or maybe even it's more charitably minded. You're looking to give away as much money as possible while you're alive, or maybe after your life. So these are all things that must be considered, and they're really trade-offs. It's kind of hard to maximize all of them at the same time. So we really help, clients balance those, and physicians with their typically higher incomes and busy lives really need to think about how to maximize these different areas of their life before diving into the strategy. Because really, your intention will probably drive the strategy and not the other way around, as you probably know, working with clients.
Right. I think that's a good point, because it's very easy to see in the news and the media. It's like a strategy of the day, a flavor of the day, and it's easy to get caught up in it. But it's really good, like you said, to just take a step back and say, like, what am I trying to accomplish? What would be my number one goal? Maybe my number two goal? Maybe there's more. And then communicate that with your wealth advisor. And then they know all the tools in the financial toolkit to pick the one that's most appropriate to achieve your goals with the least amount of risk.
Yep, you got it.
So now, great. That's a great overview. So now let's talk about one of the buckets of strategies that we wanted to have you on today for, and that is Roth conversions. So I know most of our audience knows what they are, but maybe we'll just give a little brief explanation. What is a Roth conversion, and why are they especially good to consider during down market times in the markets?
Yeah. So I actually think that term Roth conversion is a little esoteric. So you might know kind of what it is, but at its core, what you're really just doing is moving money from a pre-tax retirement account, whether that be a 401k or IRA, into a Roth retirement account, which is our golden goose, really. It's a tax-free growth account that you're looking to grow and draw from in the future during retirement, or maybe even leaving to your heirs, a tax-free account. So at its core, we're moving money from a pre-tax account into what we consider like the tax-free growth account, after-tax account. And that involves paying taxes now. That's the huge consideration with a Roth conversion, is you are moving that money into a tax-free account, but there is no free lunch. So you're going to pay taxes now. So that's just definitely something to be considering. And as far as why you might consider it now, why is it relevant during a down market? Well, similar to why would you consider buying, a pound of grapes that's on sale at the supermarket? It might be at a discount. The markets are at a discount. So the opportunity to move assets into a tax-free environment at a lower price can be pretty attractive. And then you can maximize the growth and hopefully earn a really nice return in that account going forward, all tax-free.
Right. I think that's great, because like you said, things are temporarily down, these investments that you select to put into doing the Roth conversion. And if you have confidence that these investments, maybe they're now undervalued because of market conditions, so they have a much higher chance of growing up. And then of course, there's the growth that you'd be able to get over long periods of time. So having kind of a related question to this. So when you are working with our physician clients and helping them determine which investments are best to convert into a Roth IRA or to hold in the Roth IRA, how are you deciding which ones to choose?
Yeah, in some ways, I think a similar mindset that not putting all of your eggs in one basket will still apply to this sort of decision. So diversification is important, but to the extent you have a variety of different types of accounts, you might have a Roth IRA, what we'd consider a taxable account, you might have the pre-tax IRA. Well, to the extent you can, you probably want to put the high growth investments in a Roth IRA, whether that's converting or just buying investments within the Roth IRA. Because the greater the return and higher the growth in that account, the more tax-free money you have. So I would say that is one key consideration. And then, market valuations all help determine, what you think is going to be the higher growth asset. One that's cheaper in today is better than one that's more expensive. And those are things we look closely at when making this decision with clients.
Right, exactly. Since the Roth IRA is usually like the last bucket of money that you'd want to touch so that you could get that compounding growth tax-free for as many years as possible. Like you said, you want that diversification, but you also want to try to have investments that you think will be having a good average, a higher average rate of return than maybe other investments.
Yeah, and the volatility might be higher, but like you said, if you're waiting to touch that pool of money, then, higher volatility, higher growth, you might be just fine with.
Exactly, exactly. So now that you've given us a nice overview, um, I know that Roth conversions are complicated. Does it make sense is a question our physicians have, and the answer is that it's on a case-by-case basis, and we really do need to look at things carefully. Could you briefly walk us through a sample Roth conversion?
Yeah, sure thing. I'm gonna quickly here share my screen just so you can get an idea of how we look at this. So I pulled up an example here of just, maybe you find yourself in this type of profile or maybe not, but I'm looking at a married couple that is in their early to mid 50s, and they have, let's just for simplicity, they have $100,000 in a tax deferred IRA, so a pre-tax IRA. And then we make a number of other assumptions, including what is the life expectancy. We assume you're living into your 90s. And then there are various tax rates that we have to make assumptions around. So both tax rates to you as the person doing the conversion, as well as to heirs who might eventually inherit a Roth IRA, which is a great asset to inherit because it's tax-free. And when you kind of crunch the numbers, add all these assumptions in, you get some type of analysis or chart like the one you see here. So you see like a line chart with the orange line being, what if I took no action? I make no conversion. And then the blue line being, what if I take action now and convert my entire $100,000 pre-tax balance? So, no other assets to really worry about. We're just isolating those. And you can see here that, at least at the beginning, converting a Roth to a Roth IRA is actually setting you back in a way, because there are taxes that you're paying up front. But over time, you actually are going to surpass at some point in the future the pre-tax IRA for a couple of reasons. One is, the fact that IRAs that are taxable or have pre-tax money in them will eventually be required that you have to take money out of those. So that creates this tax drag in the future when you have to start taking money from that account at age 72. Meanwhile, Roth IRAs don't have that stipulation, which is yet another benefit. So it certainly depends on the circumstances. It depends on the doctor's situation, what their income looks like now versus in the future. But even when you're considering a small conversion, sometimes these dollar amounts really add up. So in this hypothetical example, you might be looking at hundreds of thousands of dollars of savings over a long period of time, even though in the moment, it doesn't seem like it's going to create a bunch of tax value, but over time, it creates enormous tax value.
Excellent, excellent. Thank you so much, Ryan. I think it was really nice to kind of visually see, what we're doing on, and there are all these different levers, all these different variables that we can kind of play around with to find the optimal amount of Roth conversion for our physician clients. Moving right along into the next subject, which is tax loss harvesting. So, I think everyone in general knows what tax loss harvesting is, but maybe when you explain it, maybe you can walk us through an example of, how we do it for clients to help them reduce the taxes they pay. They might understand on the overview level, but kind of breaking it down step by step so that we can get the payoff for the physicians.
Sure thing. So this is another sometimes hot topic covered in the news, right, Mike? Like we've seen this, the potential value of tax loss harvesting being covered. I think the mechanics are sometimes ignored. So I think one just easy enough example to highlight is, let's say you have a position in a stock. Maybe that stock is PepsiCo, the seller of Pepsi and other, snacks. And that stock is now trading at a loss because you purchased it, maybe only a few months ago, and, markets are down now. So you have this loss in that stock compared to your purchase price. Well, you can actually take advantage of that loss for tax reasons. You could sell now, realize that loss, and that loss would help offset other gains you have, in your portfolio, as well as even to an extent, possibly your ordinary income, that you're earning, you might be able to offset some of. And then instead of just sitting it out, not being in the market for a period of time, you could buy back a very similar stock. For example, maybe Coca-Cola you're buying instead of Pepsi. And the reason that you wouldn't actually buy back Pepsi stock immediately is because there's a rule against doing that. So there's a wash sale rule. This is an IRS rule that says you can't buy a substantially identical investment 30 days before or 30 days after you realize a loss for a specific investment. So that's a road bump in the way to just kind of doing this as much as you want, because you can't buy back the exact same position. You can wait 30 days and buy it back. But there are investment considerations to doing this. And we certainly evaluate this during down markets, not only at the individual stock level, but also at the mutual fund and ETF level. So a similar mindset can apply, that you buy something very similar, realize that tax loss now, invest in something else. And the whole idea is you're pushing out and deferring taxes, which can be very valuable and really compound over time, like we showed in that Roth IRA example, right? We can just defer out these taxes and grow our assets and wealth at a greater clip than if we had paid taxes now.
I think that's great. I think especially the point about, you don't just sell it and then, of course, people can do whatever they would like, but we tend to have a preference for staying in the market because you wouldn't want to potentially get out of there, maybe be out for 31 days or so, and then the market really takes off and you miss that upside but by being in a similar security, a similar investment, you'll be able to participate at least to a good extent of how those securities are being treated in that particular market.
Exactly. It's both a tax move and there's also an investment side of this that you need to consider. You can't just focus on the tax considerations in this case.
Exactly. That's a great point. Taking it a step further, in terms of let's say you have tax losses. I know that you had mentioned a good point when we were, discussing things before the interview, is sometimes it makes sense to transfer losses maybe to a relative. Sometimes it makes sense to transfer gains to a relative. This might be something that our physicians maybe aren't as aware of. Can you explain why it would make sense to transfer losses to a relative? I mean, a loss might say, well, thank you so much. Why are you transferring losses to me? I thought you liked me, but it actually can be a good thing. Can you explain transferring losses and when it's good to transfer gains?
Right. Yeah, I think your loved ones, they might not appreciate getting that Tesla stock once it's down, 30% from a recent high, right? But the idea is, where does this stock, if it were to be sold, have the most value? So is it in your pocket or is it in someone else's pocket? Because taxes always have to be a consideration. So people don't really talk about gifting assets with losses that often, but I thought I'd bring it up. They typically talk about gifting assets with gains more often because on the gain side of thing, you would ideally, if you plan to sell a stock or other investment and you also plan to make a gift to a family member, you would preferably gift that stock or investment to a family member that's in a much lower bracket than you. So as a physician, that's very likely a case if you have a child, a grown adult child or even a younger child, that they're probably not paying as much taxes as you. So you could gift that asset with a gain. And actually the reverse logic works as well. So you can gift an asset to a loss, with a loss to someone with a higher tax bracket than you, because that loss is worth more to them than it is to you. So it takes a little bit of wrapping your head around all this, but it's something, we think about, right, Mike? And the situation of gifting an asset with a loss doesn't come up too often, but it's one you should keep in mind if you have someone you'd already planned to make some sort of gift to. Is this position with a loss more valuable to them than it is to me? I
think that's a great, pardon me for interrupting you, Ryan. I think that's a great point that you're making in terms of where is this investment from a tax perspective. I mean, looking at it from an investment perspective is another thing too, but from a tax perspective, where would it do the most good? So like you said, let's say you're a mid-career physician. Let's say, I'm making this up. Let's say you're 45 years old. Maybe you have a young adult child, like you said, who's in their first job at 23. Now, you could gift them a stock which has had very high gains. If you sold the stock, you're in such a high tax bracket because you're, making very good income, thank goodness. You'll be paying at least 15% on the federal level, maybe 20% on the federal level. And then, like you've talked about, there are things like, net investment income tax and so on. But your young adult child, maybe they're just starting out. They might even be in one of the two lowest tax brackets, which would be a 0% tax bracket for capital gains. So that's phenomenal. On the other hand, maybe you're still that 45-year-old physician and you have maybe your father or mother is a physician, and maybe let's say they're 70, and maybe they have an entrepreneurial bent, and they become the principal medical officer of a large group practice, and they're making an even larger amount of income.
Yeah.
So in that case, they might really appreciate you donating to them, gifting to them that Tesla stock, which has a huge loss, because that loss can go against maybe some of their realized gains that their portfolio has experienced.
Yeah, those are great concrete examples. And you mentioned taxes, and the capital gains tax rate could be 20% in many cases. You have that net investment income tax of 3.8%. And then we're even ignoring state taxes and local taxes for those of you, in New York City or other cities that charge income tax. So when you add all that up, that could be, between 30 and 40% tax rate combined on these sales. So if you can either shift that tax away to someone who pays much less, or get some losses from others, so you offset your own taxes. Those are all things that are great to really reduce that tax bill.
Sounds good. Sounds good. I think we're earning our keep today, Ryan. I think we're providing a lot of valuable food for thought for our physician audience. So, last question on the tax loss harvesting. And again, I find this very interesting. I know you're really up on this a great deal. You explained how tax loss harvesting works for traditional investments. Buy a stock, you buy a bond, it appreciates, it depreciates, and so on. Maybe it's a REIT, anything like that. But you brought up to me in the pre-interview that we had is, how is tax loss harvesting different for those who have losses in cryptocurrency compared to traditional investments?
Yeah, it's quite a bit different, as we discussed. Some may even call it a loophole. This is an unusual situation where, unlike traditional investments, like you mentioned, a stock, Coca-Cola, for example, cryptocurrency, like Bitcoin, as an example, there is no wash sale rule, which is that 30-day window I briefly mentioned, before and after you sell something at a loss. So hypothetically, for something like Bitcoin or Ethereum, you can go ahead and just sell whatever holding you have at a loss in that position, buy back the same exact holding, whether it's a half a Bitcoin or one full Bitcoin, whatever portion you own, and you'd be able to retain and keep that exposure that you wanted, but realize that loss for tax purposes and coordinate with your CPA on, making sure to record that properly. But definitely an opportunity that, who knows if it's going to be there for much longer as well. Because I know, Mike, we looked at a lot of the legislation changes that were potentially going to be made towards the end of last year. And that was one of them that was heavily in the mix, but just has not made it through yet. So it's very possible that they kind of do away with this opportunity at some point in the near future.
I think that's another great point that you're making, is that one of the ways that we add value to our physician clients is that we're constantly looking at changes in legislation, whether it's tax legislation, estate planning legislation, anything that can, social security legislation, anything that either will provide an opportunity that we want to really make sure our clients take advantage of, or maybe they're discontinuing an opportunity and we want to make sure that we can get as much value from that existing opportunity before the gates close down. This is the end of our first video with Ryan Graham. Please join us for the conclusion of our interview with Ryan Graham in our next video. If you'd like to talk about the strategies explained in today's video, receive a complimentary review of your investment portfolio, or discuss any of your other personal financial planning areas with an Altfest professional at no obligation, please contact my colleague Jesse Freeling at 212-796-8732. That's 212-796-8732. Or by emailing Jesse at his email address, which is in the description of today's video below. If you like today's video about providing insights to help physicians optimize their personal finances, please click the subscribe button below and hit the bell icon so you can receive notifications each time we release a new video. If you think that a fellow physician would find this video interesting or useful, please share it with him or her to help them. Lastly, as always, this channel is for you, and we want to make it as useful and as enjoyable as possible. If you have topics you'd like us to cover, like or dislike certain things that we're doing, or have any other feedback, we'd love to hear from you. So please share your comments in the comments section below, and thank you very much. Well, that's all for today, physicians. I look forward to being with you again in our next video. And until then, be well and remember to keep optimizing your finances, or let us help you if you'd like. Thank you very much.